Broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thank you for joining us today as we talk with NSRA members about embracing the new metrics in retail, how to ride the wave of post-pandemic success. We're joined here by Paul Erickson from Management One, Mark Denkler, president of NSRA, Richie Sainer, M1 retail expert and owner-operator of Advanced Retail Strategies, and Mr. Todd Mason, owner of Mason Brothers Footwear. Before we get to our content today, I did want to go over just a couple of ground rules for GoToWebinar and how to get the best experience in this session here. The first one is audio. So in the GoToWebinar platform, you do have the option of choosing how your computer audio comes through, or you can choose phone audio as well. The big one is questions. We absolutely want to take some questions at the end of this. So please use the questions panel on the GoToWebinar platform and we can answer those at the end. The most popular question that we always get is, are you recording this? And we absolutely are doing a recording. If we do happen to run a little bit long, feel free and view the recording later so you can view it with your team. Now I can turn it over to Mark Denkler, president of NSRA, to discuss a little bit of the background on our educational sessions. Take it away, Mark.
Okay, thank you. I just wanted to thank everybody for participating. We've worked out a seminar series with Management One. They've been partners with us for many years, as long as I've been in shoe retail. And they're just one of the better outfits out there to help you get your numbers and learn. And so we've asked them to join us in doing this webinar series. And so I will turn it over to Paul at Management One.
Awesome. Thank you, Mark. And hello, everybody. This is, I think, the second, Mark, if I'm not mistaken, in our series of talking about retail and the part of merchandising that we don't talk about enough of, which is the financial part of retail merchandising. But I'm going to start this off with talking about things I think we all know as retailers right now, and that retail is not brain surgery. It's typically twice as hard. I mean, if you think about it, you know, how you guys all work long hours, you guys work weekends, holidays. For a lot of independent retailers, the money is only so-so, but all the customers think you guys are multi-millionaires. And if you ever thought about this with inventory, it's impossible to be 100% right. In other words, you're in a business where you can never be totally right. You either, at the best you can be, is you bought a little bit too much or you didn't bought quite enough. But all too often it happens that we bought way too much, or we could have bought twice or three times the amount of stock and we would have sold it. So, you know, who knew? Plus, and that we also, for the last, 15 months, we have been contending with probably the greatest crisis in our economy and in retail since probably World War II or maybe even the Great Depression. Now, a lot of people that hear about Management One, sometimes we get confused with POS companies, and we're partners with all of the top POS companies throughout North America. But one of the things that we have that is really important to understand the difference between what we do and what they do is that POS companies systems measures real-time transactions. But what they don't do and what we do is they take that information to predict or control future actions. It's a little bit like a bathroom scale, using that to control your weight. It's just going to tell you exactly where you're at. And where we're at right now is that there are new metrics that I think all retailers need to be looking at in replacing some of the old metrics. Now, I can tell you that these new metrics are all going to have to do with cash flow. And why is cash flow obviously was always important. But I think today more so than ever, what the pandemic has taught us is that the retailers that were most vulnerable to the slowdown were not necessarily retailers that were in certain verticals. In other words, the common narrative, I think, was that and if you had a store in a mall, you had a problem. If you were a department store, you had a problem. If you were selling apparel, you had a problem. If you were selling shoes, you had a problem. If you were in the luxury business, you had a problem. But in every one of those verticals, there were many, many retailers that did very well during the pandemic, but only one type of retailer was universally and pretty much unanimously negatively affected by the pandemic, and those were those retailers that were overly levered. You know, you can look at the large chains that had too much debt, primarily because of private equity buyouts 10 years earlier, which loaded them up with debt, but also independents that were burdened by high debt loads from probably either bad inventory management or what I would call faulty inventory philosophies, which we'll talk a little bit about over the next 45 minutes. But that was the common factor, liquidity. And that's really what we want to talk about today on this particular webinar. Inventory budgeting and planning and creating guardrails around your inventory so that you can turn your inventory faster are more important now than probably ever before. Winging it is no longer an option as we leave the pandemic. Inventory needs to be thought of as one thing and one thing only. It's not something to fall in love with, because it certainly can be unrequited love. It doesn't love you back. It is an investment. And metrics are the scorecard for your business and how we keep score. It is really the same thing as how a pilot will fly a plane. Pilots have to trust their instruments, and we retailers need to trust our metrics. But metrics matter because they can help us become more profitable. They can help us bring in more sales. They can help us control costs. But as retail continues to evolve and adapt, I think it's increasingly critical to develop newer, more relevant metrics. Metrics that accurately value and measure retail performance. Because in many ways, the current suite of metrics that we have been using, they actually no longer exist in terms of what we need to be looking at. So the very first one is going to be something as absolutely basic as profitability. How much money are we making? You know, profitability answers the questions, am I making a profit on my inventory? Now, obviously sales are great to have, but the real reason people are in business is to earn profit. And gross margin lets us know how much profit we're making when we're buying and selling inventory, without including obviously things like operating costs such as wages, rents, and marketing. But is it enough? Now, I looked it up actually in the dictionary, because I do those things. I have a very boring life, so these are the things I do. But in the Webster Dictionary, profit is generally understood to be a valuable return or a gain in the excess of the selling price of goods over their cost. So what's wrong with that? If making a profit isn't the entire equation for the new metrics to success in retail, then what's missing? What's missing in this equation? And what's missing is that the first old metric that's going to be replaced by the new metric is something as absolutely important that we all see on our accounting statements, which we call cost of goods sold. What's wrong with cost of goods sold? Well, simply speaking, cost of goods sold, the problem with cost of goods sold is that it is what it says it is. It is the cost of the merchandise that you sold, not the cost of the merchandise that you purchased. In other words, let's take an example. You bought 50 widgets at a trade show. They came in at 70% initial markup, so when you sold them, you'd only have a 30% cost of goods sold. And of those 50 widgets that you bought, 5 months later, you sold 5. So all were at full price. All had a very low cost of goods sold. All those sales had a very high profit, but you had to pay for 50. You only sold 5. And that is why this is the first new metric, which is we can no longer look at cost of goods sold as much as cost of goods purchased. Let me explain to you in a maybe a little bit different way. Let's just look at a P&L, and then after we do this, I want to bring the rest of the panel in, and I'd like to bring in Todd and Richie and Mark on this as well. But I'm going to show you exactly how this happens. If you take a business that does $1 million in sales, a retail business, and let's just do a very basic GAAP, generally accepted accounting principles income statement. Our beginning inventory is $250,000. Our purchases over the course of the year was $700. Our ending inventory is $350. So we take beginning inventory plus purchases less ending inventory, and we get our cost of goods sold. We then take our sales less our cost of goods sold, and we get our gross profit. We take our gross profit, subtract our expenses, and at $350. And this is an example of a store that made $50,000 profit, which if you were an LLC or a subchapter S corporation, you would pay about 30% of that to the government. Now let's take a look at it from the other way around. which is not looking at it from the perspective of accounting or cost of goods sold, but cash flow. Because here's the same numbers, cash in, cash out. In other words, cash out was our purchases of $700,000 at cost. Our expenses were $350,000. Our cash in were sales of $1 million. Our cash out were $1,050,000. And then the same store that shows a profit, we still owe the vendors $50,000. So what went wrong? Why are we showing profits without cash? I'm going to bring Richie and Todd here in just a second, but the main reason is this is a retailer that is paying taxes on their unsold inventory still in boxes in the back room. And that's something that in today's world, post-pandemic world, we have to stop doing and start learning how to really monitor our cash flow. And I know, Todd, you had some examples. We talked about this yesterday that was one problem that at one time I know your business was experiencing.
Absolutely, yeah. We what you just touched on a few moments ago. Our point of sale system. We had basically 6 years of data we stared at day in, day out. Saw all the sales reports, saw the turns, but we didn't know what to do. We knew we had a problem with inventory, and that's when Management One came in. And over the last year, they really helped us navigate that problem to the tune of doubling our turns and actually freeing up enough capital to open a second store.
That's absolutely fantastic. So it was sort of unrequited love in the past with you and your inventory.
Oh, absolutely.
Right. I know. That happens. I remember years ago when I was a young lad and I was talking to a retailer, and he said, I remember in the good old days where our store was making so much money, I'd have to go to the bank and borrow money just to pay the taxes on all the money I was making, which never seemed quite right to me at that point in time. But
well, because that's the scenario right here. They needed to borrow $50,000 to keep their operations going.
Exactly.
Their accountant told them they made $50,000.
That's exactly right, Mark. And this is why this old metric, this is part of a suite of metrics that really, I think they were always, the new metrics were always there. But I think today, as we move into a different world, a world where we have to be liquid. We have to keep turning our inventory, where we have to be stronger to, survive the next crisis that's going to come along down the road. That way, I think we have to understand these things and how these things really happen, because the new financial reality is that we need to have cash flow, because, the difference between cash margin and gross margin is essentially gross margin dollars can represent profit that are on your walls or in boxes in your back room, not necessarily in your checkbook. Now, one of the things we do, and I know, Todd, you probably look at this too quite a bit, is that with our clients, we're monitoring this all the time. In other words, we are showing the cost of purchases on all our reports in every category, in every client, in Todd's store. And we're looking at what the cost of purchases are for the last 12 months, the last 6 months, the last 3 months, so that we're always looking at and saying, where are we going to get in trouble? Where are we starting to accumulate inventory faster than sales? Because when that happens, it looks a little bit like this, guys, where the last 12 months, we've got 58% cost of purchase. That's high in itself in the shoe industry, by the way. Then the last 6 months, we're at 60%. And the last 3 months, we're at 67% cost of purchases, which is simply that we are bringing in inventory faster than what we're selling it. And what the ultimate result of that will be is in that financial statement that we just reviewed. So I'd like to look a little bit at also, if anyone that heard my seminars in the past know that I've always believed in gross margin return on inventory investment. But I think now, if we're going to be consistent in terms of cash margin, we need to call this not gross margin, but cash margin return on inventory investment. Now, whether you call it GMROI or whether you call it CMROI, it still is, to a certain extent, one of the great mysteries of all metrics in retail. What is it really telling us, and how would we use this metric? First of all, cash margin return on investment is a metric in retail that combines your profitability, your margin on your sales, with your time, how long it took you to sell the merchandise. And time is a very big factor in retail. So when we look at retail buyers, and I give seminars around the country, and I said, you know, how many buyers are in the room? And we have an august body of people here that are part of the NSRA program. How many buyers people raise their hand? And I simply say, I don't think any of you are buyers. I don't think we are buyers. There are buyers in retail, because I think what we are in retail is we're investment brokers. If you've got someone working for you that as you hired as a buyer, you're not really hiring them as a buyer. You are hiring them to invest your money in merchandise. You gave them cash, which you could have bought real estate or CDs or anything else possibly, but because you're a retailer, you have chosen to give that buyer money to invest in inventory. And you have the right to ask, how well did that buyer perform? For that matter, how well did you perform? And cash margin return on inventory investment is actually the answer to that situation. Another way that I like to put it is I like to talk about it in terms of how we look at inventory performance, but look at it in a different perspective. So bear with me while I go through this very quick exercise. And let's say this is a big store. So we're going to look at vendors, and we've got two vendors we're going to analyze. Vendor A did $500,000 in sales last year and had a cash margin, not gross margin, that's real cash, 240,000. And vendor B had the same amount of sales, but had a cash margin of $220,000. Now, I would say, Mark, who do you think's the more profitable vendor here?
Vendor A, 48% is better than 44%.
Absolutely. Mark was a banker. He can pick these things out quickly. Todd, Richie, would you agree vendor A is a better vendor? Same business, but produced $20,000 more. I'm not talking paper profits. I'm talking cash margin, right? Yes. Vendor A.
Based on this scenario and the information on this slide, you would have to say vendor A, given what's on here right now.
Well, what's missing? This is the profit. This is what we're talking about. I've been talking about cash margin here, Richie. The cash margin is 20,000 more in vendor A. I don't know what you could be referring to.
I need to know, I'd like to see how fast the turns were between these two vendors.
Turns is missing.
Okay. All right. So, vendor A got the higher margin vendor, and vendor A got 2 turns. The lower margin vendor, though, got 4 turns. Now, how does that impact our analysis, though? Just a ratio. Well, let's look at it a different way, and let me see if this helps everybody that's on this webinar understand this concept called CMROI. See, vendor A, we made $240,000, but because we turned the inventory slower, we had tied up $130,000 of our capital at cost in inventory. In other words, that's not the purchases, that's the average amount of our capital tied up in inventory not selling over the course of the year. So that's $1.84. For every dollar tied up in inventory over the last year, we got $1.84 in gross profit. Now remember, this is gross margin, gross cash margin, not net. You have to pay expenses out of that $1.84. Now vendor B, we did pull less profit out, but our average cost was only $70,000, or in this case, $3.14. Let me put it to you in a different way to look at this. Let's say Todd and I bought 2 houses together, and we got really good deals on them, by the way. It was kind of we don't like to spend, Todd and I don't like to stay in expensive neighborhoods. So I bought 10 years ago, Todd and I bought a house for $130,000, and Todd bought a house the same month for $70,000 right next door. Last month, both Todd and I sold our houses. I sold mine for $240,000. Todd sold his for $220,000. Now I did sell my house for $20,000 more than Todd, but Todd only paid $70,000 for his house. He only had tied up $70,000 cash of his outlay. I threw in $130,000. That is why looking at the return on investment is everything. You cannot simply just look at profits or even cash margin for that matter without looking at the amount of capital that it took you to create that profit. we look at it from a different perspective. We give reports on this at Management One all the time because we think that's this important. I mean, if you have accessories in your shoe store and your CM ROI is $4.13, but your GM ROI is $5.12, well, what is that actually saying? What is that? What it's saying is that in these cases where your GM ROI is higher, you are accumulating inventory unsold faster than the profits that your inventory is producing. And this is something that, if not monitored and not looked at like a pilot looks at his instruments on flying his plane, if you're not monitoring this, what can happen is at the end of the year, you'll be sitting in a situation where too much inventory, too much profit coming from that unsold inventory. This is simply looking at it from the cash margin against gross margin. And I think, Nico, we're going to have this, we can send this out to, and we're going to record this. So, and if anybody has questions about these concepts, we're here, obviously. Okay, let's talk about an old metric. How much, what an easy metric, right, Mark? How much inventory do you have? I mean, how much inventory do we have there? And so people will always tell us how much they have at cost or retail. But what's really important is, how much inventory is current? And how do you define current? That's really, I think, one of the most important things. So how do we age our inventory, and what is our inventory's true worth? And I think, Todd, you know, you were talking a little bit about that, as Mark, you were too, about the whole idea of this of shelf space, and this whole idea of like, from a grocery store perspective, of how important shelf space is, and not to waste that space on merchandise that is not current, is not selling.
Yeah, most stores only have a finite space to put their stock in. You might go 13 high, the fire marshal might get mad at you, but you have to, you know, you only have so much in there. So you need to turn that, and you do need current inventory. And I will say, some of the, I know my inventory system, it would tell you on the box when you receive that merchandise. And every now and then you should go through there and just make sure that you don't have anything that's old. I mean, if it's over 2 years, it should be on your sidewalk sale or something like that to get rid of it. At that point, it's just taking up space. You need a better shoe in there to make more margin and more profit.
Yeah, and I would even go further to say,
if it's over 1 year old, it ought to be on there.
Oh, yeah.
Well, and I'll even say that, from our store's perspective, and I think this probably is true for a lot of stores. You know, I mean, we had inventory that were 2, 3, 4 years old, and it goes back to, you know, we paid $40 for the shoe, and there's no way I'm going to ever sell that shoe for less than $40 and lose money on it, which is just not the right way to think, as Richie has coached us through, and proven that, you know, selling that shoe we paid 40 for, selling it for 20. At times, and turning it 2 or 3 or 4 times in that period is far better than sitting on the inventory. So that was a mindset change that we actually had to get past.
And Todd, one other thing too, if, and God forbid this was true, you know, there's an old adage in retail, never have a birthday party for inventory, right? And everyone kind of laughs and they think, yeah, that's true. You know, I do keep some things over, but you know, why would I get rid of it if I'm just going to reorder it next year? And the problem with that is that even the IRS, the beloved IRS, does not agree with you carrying over merchandise. I asked that question to one of the top tax accountants in retail 2 years ago, and I said, what's the IRS's position on inventory more than a year old? And they said it's 100% write-off, because the IRS doesn't think you should pay taxes twice on the same item you haven't sold. And that's essentially what's happening. When you carry things over until the next year because, well, it doesn't sell this year, so we'll just carry it into next year because we just reordered anyway, and there's a lot of fallacy to that comment to begin with, but you are also paying a tax. If you've got a $50 item cost and you suddenly start carrying it over twice and you're paying 30% on it twice, so in other words, you've got a $15 tax on it the first time you counted it, and then the next year you've got another $15 tax on it. You've already got $30 in taxes on the $50 item you haven't sold yet. And the IRS says, don't count it. Don't pay for more. This is all part of what we have to start thinking about in terms of how we look at our inventory in general. It's very, very important. I mean, to be really honest with you, I'm going to give credit where credit is due on this slide. because this was actually Richie Sayner's metric that from many years ago in the shoe industry, and I believe if anything, it might even Richie have aged a little bit, so that maybe if 20 to 30% of your inventory is older than 6 months, you have a potential problem. It might even be, less than that, you still have a potential problem. But I've always believed, and this is a good way for everyone on this call to start looking at your inventory. 30% of your stock in a shoe store that is over 6 months old, you have a problem that needs to be addressed now. Think how long 6 months is, and it still hasn't sold. And I know we can justify and we can rationalize all we want, but the point of the matter is that it's still your dollars tied up in inventory that hasn't sold, and God forbid you count it twice at the end of it.
Also, Paul, when you go 6 months, you're into a different season. You're not, right. That sandal is sitting there, once again, finite space. So that sandal is taking the place of maybe a boot or booty or a fall shoe, say, if, going spring to fall, that you could be selling current merchandise versus keeping it in your wall until the next spring.
Well, Mark, that's what I was going to say too. That's an opportunity cost.
It's an opportunity cost, yeah.
Right. And if we're not getting the turn out of the cash out of that inventory, we're missing the opportunity to sell products that we could have come in that would have sold during that time with that money.
Yeah, before the next season, we would always go through, and as much as you don't want to sell it for less than cost, sometimes I would give it away. I'd rather give it to somebody who needs it and give it. We have a migrant association nearby where people just don't have the money. They're the farmers, picking stuff. Just give them the shoes and get something new and make more money. Turn that space into money.
And let me add one thing too, guys. Everything you said is 110% accurate. One other thing too. What has been proven in studies is that if you're not replacing your inventory as quickly as you should, if you hang on to inventory too long, which I do think is a malady in our particular vertical, the shoe industry. I do think that is something we've got to squash. What the studies have shown is the customers don't come in as often, because why should they? They're seeing the same things all the time.
Well, Paul, my favorite saying, Paul, and you and I have said this for years. When people come into the store, how many times have they said to you, I really want to see that inventory that's a year old. I don't want to see the new stuff. Show me the stuff that's over 6 months old. Show me the stuff that's a year old. That never happens. New merchandise drives full price profitable sales.
That's exactly right.
You always want freshness.
Freshness. If you worked with a vendor that showed you the same styles last season that shows you the same styles this season that they showed you last season, you'd stop buying that vendor. Well, wait a minute. I want to see what's new. And so why should you be any different with your customer? If you start replacing what we have shown that works, is that and this is, by the way, the new retail, by the way, what happens is the longer you hang on to merchandise not selling, that cuts into your open to buy. How can you buy more new product if you're hoping and wishing and dreaming that merchandise that's been there for 9 months is going to sell at some point? You've got your capital tied up in unproductive inventory, which affects your open to buy. You're not bringing in enough new. The real secret sauce, the real way to, if you want to grow your sales and really be more profitable, then make sure that you do not hold inventory for as long as you are holding it today. The secret sauce is less holding of inventory and more buying of new inventory. And those things go hand in hand, and they are completely related to customer visitations like Mark and Richie and Todd are talking about.
Well, there's also, you shouldn't keep a shoe in the same place for the whole season. You should be moving it around. It should go from one wall maybe to a place where it has something more prominent, but you don't leave every shoe in the same place. You want that customer to come in, even though you haven't changed shoes in 2 months, you're waiting for your season to kick in or go, you still want to move that shoe around on your displays. You don't want that way they come in, they always think it's something different. They'll always pick up and go, oh, is this new? And you're thinking to yourself, I've had it for 5 months. No, it's not.
Right.
They buy it and you're happy, but even you have to keep fresh on your displays as well.
That's
and that in turn will help your inventory move.
Very good point, Mark.
Yep. Great point. It's all about turnover, guys. That's what we're talking about. I know Richie and I have been flapping our gums about this for decades to shoe retailers all over North America, but it's more important now than maybe ever. And the thing with turnover, this idea of time, how long it took you to sell it, it doesn't even appear on your P&L because accounting doesn't even factor the element of time, ergo the accounting statement that we just showed. Now, there is a new metric, another new metric. It's not a new metric, but it is a metric that is, I think, deals with exactly what all four of us are talking about. And that is called a stock to sales ratio. Ladies and gentlemen, you need to look at your stock to sales ratios way before you look, and dare I say it, here it comes. Anybody who has a heart condition, please turn off this webinar at this time. It's more important than your margin. Now, I know margin's important, but you can't take margin to the bank. A stock to sales ratio is actually how fast you are replacing that inventory. I can't tell you who it is, but it's a very large company in the National Football League that we're doing all the planning for. They have an august panel of planners that work for them. Trust me, they've got a lot of money, but they hired us because they felt we were the best planning system that's out there. One of the things that one of their planners, who was one of the top planners that they just hired, I think she came out of American Eagle. She said, you know, the most important ratio that we look at in planning, and the most important metric that we look at when we're looking at inventory productivity, we think stock to sales relationships are everything. They're sort of like your sell-through. They're the reciprocal of your turnover. But what it is something that you need to start looking at. In other words, if you say, I sold $10,000 in this vendor last month, well, that's fine. But if you had $300,000 tied up in that vendor, 10,000 doesn't impress me because the ratio is 30 to 1, as opposed to you sold 10,000 and you only had 40,000 when it would be 4 to 1. You see why that's important? You have to include that in your analysis. And that gets back to something that I want to really open this up for our panel, and that's called narrow and deep. We talk about it all the time. You know, I used to talk about Pareto's rule, which is the 80-20 rule. Well, I've taken a gun out and I've killed that sucker because that's no longer, and no one should be operating with the 80-20 rule, which says 80% of our inventory is only producing 20% of our sales. And so one of the things that we need to do is to understand how just a few SKUs in your shoe stores can dominate a classification, just a few styles and a narrow array of colors and sizes can really dominate your business. And that's why we would urge everybody to start bringing those assortments down and being much narrow and deeper in that. What that will prove to happen is that it'll accelerate your sales. You'll have less missed sales because a wide and thin strategy of throwing as much stuff against the wall and hope some of it sticks is not only not playing it safe, but it can be deadly. And I'll open that up to the panel on that because I know Mr. Sainer has some things to talk about that, but I think Todd also would love to hear from you too.
Yeah, sure. So, you know, our store is, I don't know that it's necessarily unique, but, you know, for example, work boots, that's a big part of our business, but we also cater to the running crowd and the casual folks as well. But so when we're looking to invest in maybe like a new boot, for example, that's, you know, has a high dollar cost to it, in those cases, we actually look at historical sales and we know the probability of the purchases in certain sizes that if someone comes in, we know with 80% confidence they're going to buy within about 5 different sizes of that boot. And the reason I say that is we keep that fairly shallow with a new purchase on a high dollar boot. If it starts turning well, then we go deep. On the flip side of that, with other shoes such as the casuals, we do go narrow and deep on those products.
Just because what you're saying is you test on the more expensive merchandise.
Yes.
Right, and then you'll go a little narrower and deeper on lower priced goods that you won't have the dollar exposure on. Is that right,
That's
Tom?
right. That's correct.
But you also need to talk to your vendors because in today's environment with supply chain issues, you are writing your initial order and you're backing it up, where the old days they would have that in stock for you. So you do have to watch what everything that's being thrown. This is a different thing where you didn't have to used to write futures as much. They can't get as much projects or products, so they're buying it narrower or they're basing it on your orders. And if you expect them to have it in stock, it's going to be tough. So you do have to watch, but also talk with your vendors they'll tell you, okay, we think we're going to back this up. It's going to be a great shoe, but you got to make sure that you do have future orders on those. Where in the past, like Todd was saying, you can always test it, but it's a little tougher to test in these waters now.
Yep.
Very true.
Yep, very true, Mark. That's actually a great point. All the more important for planning. All the more important to know how much you're going to be spending in the future, because there's not going to be the backup that we've had. And that's, I think, Mark, too, it's been something going on in the shoe industry, not just since the pandemic. It's been, I've been hearing that every season, like there's less and less at-once goods than there used to be. Okay, let's talk about markdowns a little bit, okay? And markdowns, a new post-pandemic rethinking. Look, a lot of this wasn't really, it's not just post-pandemic, but I think because we're talking about cash flow and how these things go together, we do need to talk about this whole idea of markdowns, because markdowns are a cost of doing business. There's no question about it. But the one thing about markdowns that's good is that I think markdowns enable us, if we take them, if we admit our mistakes, we learn from our mistakes. I've said for many years that markdowns are sort of like a tuition, an expense, a tuition expense that you pay for your better understanding of your customers. And so markdowns, I think, in a post-pandemic world are actually becoming more important, not less. So I want to talk about two fallacies on why people don't like markdowns. And this is generally coming from financial people or maybe accountants. Number one, if you understand, I know you might have to take a markdown, but understand that markdowns are increasing your cost of goods sold, and that you're going to lose money when you take markdowns. So try to avoid them at all costs. Well, let me just say about markdowns, number one on that. Markdowns are not a zero-sum game. What do I mean by that? In other words, when you're taking markdowns on shoes that aren't selling, and there's nothing wrong with making a mistake. By the way, making mistakes in life is how we learn. So first of all, making a mistake is not the problem. It's learning from the mistake and reacting to it. But it's not like you're going to sell off those shoes that were on those empty shelves on the illustration here and not replace them. Because if you were going to sell the shoes that weren't selling and then not replace them with new product, something different to show the customer, to mitigate the markdowns that you took, then of course they would be a zero-sum game. But they're not. Markdowns are a way to keep inventory flowing in and out and cash flow so that we can bring something new in that will hopefully sell better. Fallacy number two, if you start marking down too much, they're only going to buy on sale. You are going to train your customers to only buy on sale if that is what you're going to start doing. That actually can be true. But if you don't know how to handle markdowns correctly, that can be true if you do two things. First is you take timid markdowns. In other words, that shoe that was $150 and it's not selling. And, I listened to these guys on the NSRA webinar, and they were talking about markdowns. And I probably should. I got to get my cash back. Cash flow is always an issue with me. And so the $150, the first markdown is your cheapest markdown type of thing. $150, we'll mark it down to $129. Well, it didn't sell at $150. It's not going to sell at $129. So we go to 109. It didn't sell then. And then we go to 89. Didn't sell then. That's a horror story. That's now when you're now half your floor, because you're more worried about profits than you are about cash flow. This all ties back to cash flow is everything in the post-pandemic world. And so the way to really avoid that is to take an aggressive, hard markdown on what's going to move that shoe in the next week or 2 weeks to get rid of it. Don't worry about profits at that point. With expenses the way they are, even at 20% off, you're starting to lose money. So just get the cash back as fast as we can. The second way is we never take markdowns in season, Paul, because, I don't want to be a sales store. And so we just run 2 sales a year, and that's how we do it. Well, that's fine. That's good. I like that approach. But make sure that when those sales are run, we have a low amount of inventory to get rid of. Because if you are accumulating inventory to the point that your 2 sales a year are gargantuan cash-raising sales, guess what's going to happen? If you run that sale in July, watch your June sales continue to plummet. Why would I buy the sandals in June? You're going to mark them down in 3 weeks. And so those are things that I think can create that problem that they'll only buy on sale. And so one of the things that I mentioned at the beginning of the webinar is that we're talking about an inventory management, but also an inventory process. And this is all part of what we teach, is the inventory process of how to mark down and deal with problem merchandise quickly. And Todd, I know you were sharing me some things about how you mark down too. Maybe you'd share with everybody.
Yeah, I mean, to your point, we start off right at 30%, and we'll go deeper than that out of the gate. So, and this year has been a little bit unusual in the fact, and we talked about this yesterday, that there's just not a lot of available inventory coming in with new items right now. So it's a little bit different. But for those that where we are getting new inventory in, we are taking the old styles and marking those down right out of the gate.
You know,
Paul,
yeah,
I'd like to bring up a point that I know you agree with, and you've usually brought it up before, but it needs to be stated in markdown. It said the cost that you paid for the shoe has nothing to do with the markdown price, or it shouldn't. But so many stores, especially shoe stores that I speak with, are saying, well, I can't go below cost.
Right.
Well, I don't think cost has anything to do. What you paid for it is nothing to do with the price that your shoe's going to sell at.
That's
You're
exactly.
already losing money at it.
That's
Yeah,
exactly
I
right.
mentioned it at the beginning. He used to not want to say a shoe costs $40. He didn't want to do it. But once again, it's just sticking there at $40. And also the key on sales, turnover is key. The faster you get that out,
Yep.
then you're making room. Once again, you got to get it out. You know, say if you don't have any sales after 30 days or 40 days, then it's time to maybe put it in a value corner. Or even if you do have 2 sales a year, people still want to walk into your store and go, the first thing you use to go, what's on sale?
Mark, one of the things that I ask my clients is, they say, well, should I mark this down? And I said, do you want the money?
Yeah.
And they say, well, of course. I said, well, then mark it down, because you're not selling it now.
But if you get it in January and you wait for your Easter sale or your spring sale, that's going to just sit there at that price. It's not worth anything. But if you can get it down, we all know there's certain brands that do sell on sale the first markdown. You don't have to go to the second markdown. So if you have one of those and it's just, you know, everybody thought it was going to be a home run and it's not, get it out there. You know, it doesn't fit right. If the company will take it back, great. But if you're stuck with it, get it out of the store. Because all it's doing is tying up, lowering your turnover, lowering, you know, eventually hurting your cash margin.
Absolutely.
Absolutely right. So just real quick on the art and science of taking markdowns, because I think there is an art and science to it. Number one, which we should have a budget. We should know how many markdowns we can take. What's our profit projection, and then what's our initial markup, and from that we know we can then tell how many dollars we should be taking in markdowns. We should have a general idea of what's the right amount. And then when you do take markdowns, I believe it's very, very important to give the customer a reason why. Now, why is it marked down? What I hate when I walk into stores is just to see a sale sign up, right? There's no reason why it was marked down. It's just on sale. Well, there must be a reason. It's the end of the season. It's a special purchase. It's a weekend promo. Whatever it is, tell them why. Because if you don't tell them why you marked it down, I think you invite every negotiation with a customer to be a little bit like, well, Phil, you know, you marked these shoes down, but when are those going to be marked down? Because you never told me why. I talked a little bit about the first markdown being the cheapest. Make the first markdown is your cheapest markdown when it works. It's got to move the product right away. It's important. What do customers say when they come into us? What's generally the 2 things customers look at in general in retail? What's new and what's on sale. If you don't have either, you're in trouble. And by the way, a little thing, just this comes from, you know, I went down the rabbit hole a few years ago in terms of psychological pricing, which some of you have seen some of my presentations on that. But what a fun one is actually make sure if you put something on sale and you have a compare at price, make sure the sale price is on the left of the compare at price. You would think that wouldn't be a big deal, but it is, because we expect smaller numbers to be on the left side of larger numbers. I don't like percentage off unless it's 50 off. Number one, percentage off, because you're making them do a mathematical calculation when we're all challenged by math to begin with. And I also think what Todd was saying at 30% off, I think in 2019, in holiday of 2019, they actually had a survey of female customers who asked them what percentage off would you have to see to walk into a store you normally would not shop? And the answer was 40. And so it's beginning more and more. That's why 20% off hardly works at all anymore.
Right.
You know, 'cause we want more and more and more. So if we can say, so there's lots of techniques, by the way, on marking down. Like you can say how much you're saving. Save $10 in every pair of shoes. You know, that's, you're accentuating a positive, not a negative on that. And then, as I said earlier too, when you mark down, yes, you are losing money on those sales for a brief point in time, but at least learn from them. Why didn't it sell? So, you know, I think a lot of this, and I promised Mark we'd be done in 45 minutes, and Mark, I'm close to it. I've been keeping my eye on my watch, buddy, so you got to give me credit for that. But I think one of the most important things that we're talking about is that what data should we be looking at? What are the metrics on your dashboard, in your computer system, in your reports that you should be looking at? Are you looking at things that are measurable that have to do with your cash flow, more importantly, than just a paper profit? Am I going to start using data going forward to make decisions that will help me grow my sales and increase my cash flow and lower any kind of debt I might have? Or am I going to continue to just wing it, possibly like we always have? Look, one of the things that we're talking about here, and the metrics we're talking about, is cash margin against gross margin, cash margin return on investment against gross margin return on investment, inventory turnover in the idea of stock to sales ratio, inventory efficiency in terms of how fresh your inventory is. These are things that, in some ways, when you look at your accounting statements from your accountant, are shifting a little bit away. I'm not saying income statements are not important, they are. But I think too often we don't look at our balance sheet as much as our income statement. And I think, Mark, you are, of everyone on this panel, definitely the right person to talk about that from your background.
Well, you just have to maintain and just watch all those things. And one of the things I was thinking about, our last seminar, we did talk about stock to sales, and that how important that is. So maybe when we send the recording to this out, we can send the recording of the stock to sales and the metrics and turnover that we're watching then, because that's so important. But all these metrics are so important to look at, you know, because the balance sheet just tells you what you look like at one day of the year. There's 365 days of the year.
Right.
So you need to, and that's where you're getting turnover, as you said. That's not even on a financial statement, but it's so important.
Yeah, the closest that you'll get to turnover is actually on the balance sheet when you're looking at the amount of inventory. So I guess we're going to end this presentation now. If we've got some, we'll open it up to questions. But you know, I love Dwight D. Eisenhower. I think they just listed the 5 greatest presidents, and Dwight Eisenhower is in the top 5 greatest presidents. But he says it's not the dog in the fight, it's the fight in the dog. And really, how are we going to use knowledge? Because knowledge is liberating. I think the one thing that our clients tell us is that they now know what they should be looking at, so they can make decisions based on their data, on knowing what to look at and how to make decisions from it, so they can attain that kind of security and peace of mind. So, Nico, do you want to come back in? And if there's any questions anybody on the call might have for the panel?
Absolutely. Thank you, guys. And thanks for the folks staying on. We got about a vast majority, 80% of the folks still on. So if you guys have a little bit of time, let's take a couple of questions here. First one, John says, so to keep old inventory from taking up valuable floor space, you were talking about this, Mark. He says, I put it in the back room and push it hard on my website. So does that somehow, can that extend the 6-month freshness rule you talked about? How does that factor in?
Well, it does in some way. I mean, I had stores in Florida, so we only had one season, which was spring. But once again, if it's in the back of your store, it might sell like a spring shoe. You might have it on your website if you're a northern store, and somebody down in Florida or Texas or in the South where it's usually hot and are selling spring shoes, they might buy it. But then a fall shoe really only has it when it's cool. So it depends on the season, on where you are. You might get some sales of some spring based on people who are in a different area. Your customer that you go to most likely wouldn't, unless it's cheap enough. But they're not looking for a sandal shoe in December.
I'm wondering if Todd, I think you sold some things online that you might be able to speak?
We did, and I will say that for us, web sales has been a great avenue to liquidate inventory, and a great example. We had some running shoes. In fact, we were way overstocked on them, and we've marked them down 50% and sold everything within 3 weeks. So
Yeah, I think one of the, and Todd won't tell you that, and I'm not telling any tales out of school, but last year during COVID-19, Todd Mason was the only shoe store that I worked with that had an increase in sales every single month of the year except for the month that he was closed. I mean,
Right.
not too many shoe stores can claim that.
well, thank you.
That's fantastic. Next question here.
Yeah.
So Sarah is asking, when we were talking about CMROI, Paul, you mentioned paying taxes at year's end. So
Yeah.
is this something that you evaluate once a year, once a quarter? What's the right time frame to really look at these metrics that you were showing?
Well, we're showing them every month, and they're not going to be, your cost of goods purchased against your cost of goods sold are not going to match up perfectly every month. There's going to be times when you're front loading inventory at the beginning of the season where your cost of purchases are going to be much higher than your cost of goods sold. But over the course of the year, it needs to certainly balance out. I don't think that, I think too many retail, I have brought this up and Nico, you know this, because every time I bring this idea up of paying taxes on your inventory that you count, it's almost like a big surprise to retailers, and they never think of it that way. But really, assuming you have a profitable business, everything you count at the end of the year and give your accountant as your ending inventory, it is something you pay a tax on. And so, and again, the IRS has already weighed in on this. If you carry inventory that you don't count anything twice, because even the IRS is saying we don't want to double tax you on the same pair of shoes. So don't count it, and they're fine with that. You can keep it in the store, you can sell it, but you don't have to count it as inventory. So I would have a powwow with your accountant on this, because I do think too many retailers. I was talking to actually a retailer in Alaska who had a really good year. It's like Todd, he had another good year. He's in an outdoor business though. And, he had a record profit. And for years I was telling him that he shouldn't be carrying, he has Carhartt, which is basic stuff. Well, he was carrying way too much inventory there. And so he told me, he said he had $200,000 in inventory that he said he counted this year that was there from last year. Shame on him, right? And so I said, well, if you just don't count it, you're going to save at 30% of 200,000. That's $60K that you're going to save on taxes. That's a meaningful number. But in the past, he just went ahead and just counted the inventory and gave it to his accountant. You don't do that.
The ending inventory number.
The ending inventory number, right, Mark?
Right.
Excellent. Final question. Doug is asking, way early on in this presentation, you mentioned that the POS system isn't giving all the data that I need. So he's asking, do I need a new POS system? What am I missing?
I think, can I jump in first and then I'll turn it over to the guys, okay? I think that in most POS systems, they do, not all, but in most POS systems, all of the information is there. But because most POS systems are, the reporting is not done by retailers, but done by tech people, it's not done in an easily usable or reachable or achievable way that they can get that information. That's my opinion.
Yeah, I mean, if you can, most systems will let you you'll set up a class structure, you'll be able to get sales, you should be able to get markdowns, you should be able to get cost and retail receiving, and you should be able to get your inventory at cost and or retail, and you should have a way to track your merchandise on order. And of course, transfers in and out. Apart from that, from the metric standpoint, to drive any merchandising plan, that's the information you need.
Right, and I was going to add, this is one of the reasons why the NSRA partners with Management One, and we do these education series, but a lot of our clients, or a lot of your clients, actually, you have the slide of a lot of your clients, I have to say, half of those people were the retailer of the year of our organization for a certain number of years. And I know Richie and I talked, and he's like, a lot of times I said, this guy is brilliant. Why is he using your services? Your services, you have extra things. You put it into a different way to look at it, and then you have that extra set of eyes. We all could be great buyers. Like I said, yeah, we get dogs, and we have to put them on sale, but you guys are the extra eyes for those people, using that professional look into your proprietary systems that helps you analyze their business better. But yes, every inventory system will give you what you need to do, but sometimes you have to get 5 reports to get what you want.
And I think, Mark,
people aren't imagined. And
what your point is, it's an outside, independent, neutral view on your business. Okay, it's not like one of your buyers telling you what they think you want to hear, or even your spouse for that matter. It's an independent, objective counselor that has a vested interest in the success of your business. Exactly.
Because when Rich and Paul are talking to people, they're not in love with that shoe. That shoe is a number that's looking really bad on their report, and they're like, get rid of it. Oh, but gosh, I love this, and it was a great seller 5 years ago, and I've kept it for 5 years. Well, it's time to get rid of it. It's sitting in the inventory.
The one piece I would add to that too, when you're looking at POS, when you're looking at it temporarily, the POS system is looking at everything that happened in the past.
Right.
And when you look at what Management One brings to the table, we're taking available cash flow and applying it to what products you should buy in the future, in what particular classifications, to maximize your profits based on what happened in the past.
We're looking through the front windshield rather than the rear view mirror.
Right.
Perfectly put.
Yeah,
and you're doing that once or twice a month versus, at the end of the year looking, where was I? Or at the end of twice a year, where you look at the end of the season, how do we do in the spring? How do we do in the fall? You're looking at it all the time, because as I said, some numbers are dynamic where they're changing, and some are static. Like a balance sheet is a static document. This is what you were on this date and time. We have
one client. They have multiple stores, and they have a buyer. Her name is Adrian. And I call it the Adrian rule. And what Adrian does, and one of her tasks are to be looking all the time, is she goes and scours each category and subcategory in each store and looking at historical numbers. And what she's looking for is stock to sales ratios that are too low. Now, remember, that may seem weird, right? Wait a minute, too low. Don't you want the ratio to be lower? To a point. But what she has done for this retailer is she's simply going, I believe that we could sell more if we increase our assortment in these months, in these categories, in these stores. Her whole job is to look for opportunity. And opportunity can be found in your database. You just have to know where to look.
Yeah. And it can also be by how you categorize certain shoes. As we all know, athletic has done fantastic. Slippers were doing fantastic based on the time. But if you just added, athletic shoes, what type of athletic shoes was it? Was it a walker? Was it something that comes in sizes? There's so many different subcategories how you can analyze, so you can look at your money on how you're going to go in the future and buy.
That correct, Mark. I mean, it's important to talk about subcategories. We call them child classes at Management One, but our whole thing is drilling down into deeper levels to look for those opportunities, and then also those are, why in the heck are we carrying 2 years worth of inventory here? So that's and I know, and this client, but I know we have other clients that they literally have assigned their people to go look for that. Go into the database and find those areas where if we could put more shoes in, we'd sell more shoes.
Yeah.
And it also, it goes back to bandwidth. A lot of retailers could do this, but do you have the time to really search that database? Do you have a sales force on hand to really look at the database? Retailers are often focused on issues of urgency, daily fires that are going out. They have a store to run. Right. They have tons of other things to worry about, from marketing to employee issues. A lot of folks just don't have the time to look at this. So I love the fact that Management One is that advocate hanging on the side there, really crunching the numbers each month.
So institute the Adrian rule. Find those areas.
I would say from our learning as well, yes, it is a skill set, and you guys offer the tools that every retailer needs, but who can afford someone really full time? So being able to farm this out to Management One, And I'll be honest, when we first started this project over a year ago, I thought, man, how much is it going to cost us to do this? And now I look back at it and I think, how much would it cost us to get rid of Management One? So you went from an expense to something that really adds so much value to our organization. It's fantastic.
I don't have anything to say.
I was going to say, I think that's the perfect place to end it on there. Thank you. Couldn't have said it better. Well, I definitely want to thank everyone for staying on with us here, and we certainly appreciate the time that you guys have devoted here, especially our panelists. Thank you to Todd Mason, Richie Sainer, Mark Denkler, and Mr. Paul Erickson. And we'll look forward to our next session next quarter, which we will be messaging out soon. We did record this, by the way, so we'll be pushing out a recording to anyone that might have required to leave here. But thanks again, guys.
Okay, thank you all.
Thank you.